Hey, what's going on, guys? This is Blood Phantom 81. Welcome back to my channel, and thank you so much for checking in. Today, I'm going to be talking about a few positions that I don't plan on selling ever, and obviously that may change in the future because the future is an uncertainty. But based on some features which I'll talk about in this video, I hopefully won't sell these positions. And so, as you guys know, the S&P 500 has had a really rough ending to 2018. Over the past 4 or maybe 3 months, there's been a lot of volatility and some really huge swings. So today, I'm going to talk about some of the positions that I managed to get into at a very comfortable average cost. So the first position I want to talk about is actually one that I'm down on right now. My average cost is not that great, but that's totally okay. I'm fine with the amount of money that I have in Apple right now. So my average cost on Apple is right here at 166.92. Let's just say 167, where it currently sits at 157. So I'm about $10 a share down, or basically 5.42% down on this position. The reason why I got into Apple was because if we take a look at it from a weekly time frame, the volatility that we saw is nothing out of the ordinary. So we came back, retested the 200 week moving average, which we have done every 3 or 4 years for Apple. Weekly RSI got oversold. It felt like a textbook buying opportunity. If we do start to drift below the 200 week moving average, let's just say like maybe 125 a share, then I may consider moving my money out of this position. But as of right now, I'm very happy with it. Apple pays around a 2% dividend yield, and that's probably going to increase every single year. I'm sure they want to get the reputation of a company that can pay the dividend and increase the dividend every single year. So I feel good about that, and they're probably going to grow their dividend by around like 10% every single year as well. So that's definitely very enticing. As far as like the 52-week high and all that stuff, so over the past 3 months, it's down around 28%. Over the past year, it's actually down 8%, but the 52-week high sits here at 232. So if we get back to 232, this position is going to look really, really solid. So here's hoping that Apple can recover. The next stock I want to talk about is NVDA, or AKA NVIDIA. So this one is a semiconductor stock. We all know what NVIDIA is. It's probably one of the largest semiconductor stocks. My average cost on this one is around 139. So on this one, I am up 15%. And I have about 1.2K in NVIDIA. So NVIDIA over the past 3 months is actually down 21%. Over the past year, it's down around 32%. But the 52-week high sits here at around 289. So because my average cost is 140, around that range, if we get back to the 52-week high, then this position would have doubled and been a whole 100% in profit. So that's something that I'm very excited about. NVIDIA does pay a dividend yield, although it is pretty small. I'm not investing in NVIDIA for the dividend yield, but I do think that this move was kind of blown out of proportion. Once again, if we look at it from a long-term perspective, at least from a technical point of view, we came back, retested the 200-week moving average, nothing out of the ordinary, and now we're bouncing once again. So NVIDIA has actually shown some really strong weeks the past couple weeks, as well as the entire semiconductor sector. If we take a look at something like MU, same exact thing, came back, retested the 200-week moving average, and now we're bouncing very strongly. I actually do have a position in MU, which I'm happy about. It's a little smaller, but it is what it is. So I have about maybe $390, average cost being 32. Currently, I'm up on this one 22%. However, MU, even though I'm talking about it today, isn't in the stocks that I would never sell. You know, I'm okay with selling this one in the near term. We'll see how quickly it recovers, though. Over the past year, it's down around maybe 10%, but the 52-week high sits at around $62. So this is one where I would also get about 100% return if it does get back to the 52-week high. We'll see if I even hold it for that long. MU, I don't feel so good about in the long term. Same thing with AMD. AMD and MU, I consider, I wouldn't hold them for the long term, in my opinion. So yeah, let's go ahead and take a look at another stock that I would never sell. This next one is actually Lockheed Martin, ticker symbol LMT. So Lockheed Martin, I have about 4 shares maybe. Yeah, 4 shares. Average cost sits at 267, which means I'm currently up 7% on this position. All in all, I have about 1.1K in Lockheed Martin. Let's go ahead and take a look at it from a long-term perspective. So Lockheed did dip below the 200-week moving average. Weekly RSI was oversold, however, and I think that was kind of the trigger for a lot of buyers coming in. We captured this moving average relatively quickly, and so now we're back above it. Looks like all systems are set to go for Lockheed Martin to get back to 52-week highs. One thing I want to note is, yes, we did break below the 200-week moving average, but it's really about how we react once we try to get back above it. If it were to have gotten rejected and start to head lower and make a lower low, that's a completely different signal than just breaking down below it for a couple weeks and then quickly recovering. So I just want to make that clear, because I don't want to have like an inconsistent kind of approach to how I'm trading stocks, because clearly I put a lot of emphasis on the 200-week moving average. So that's just my thought process on that. However, it's important to not take these as the Bible. It's important to not take moving averages as the only reason to buy or sell a stock. It's definitely more than that when it comes to stock picking, in my opinion. So Lockheed Martin, I definitely like. The next stock I want to talk about is Ross. And so Ross is actually not a growth stock like the other ones I mentioned in this video, but I plan on keeping this one for the dividend growth. Kind of interesting about Ross is that it didn't take a hit in October like the rest of the stock market did, but it actually delayed it about a month. And so on November 8th, we made a high of about $103.33. And then right after, we just plummeted. So Ross in total, let's see how much it lost. Let's see how much it lost. So Ross lost about 27% in this entire stock market correction, which is actually pretty high, pretty significant for a company like Ross. However, from a long-term perspective, still above the major moving averages. So to me, this was a no-brainer to get back into Ross. So that's why I started scaling in. So the interesting thing about Ross is, yes, I have about 6 shares. And yes, I'm up about 13%. Currently have about $554 on it. But my average cost isn't that good because I started buying super early. So let's see. My first buy was on November 20. And then a couple more shares on November 20 as well. And then kept buying around November 20. So November 20th, November 21st, November 23rd. So I didn't wait for the exact bottom to happen. Whenever you have a stock market correction like that, it's the average cost isn't that important. I mean, yes, it is a little important. You want to have a good one at least, and you want to try to have a good one. But if you're a little early to the party, that's fine. It's not about getting the perfect average cost. So that's another stock I want to talk about. And the last stock I want to talk about is Target. So Target is definitely pretty controversial. It's one of the stocks that people think is going to be most affected by e-commerce. However, Target is definitely putting their stake in e-commerce as well, and they plan on selling their products that way. It's actually one of the few retail stores that actually see growth in terms of customers coming to their stores. So Target is kind of unique in that sense. Currently, I have about 6 shares, aka $434 of a position in Target, and right now I'm up 12.24%. So pretty happy about that. Let's see, I think I got a dividend recently. No, probably not. Okay. So this one I'm also holding out for the dividend growth, and essentially I don't think I'll be reinvesting my dividends in the traditional sense when it comes to this Robinhood account, because my positions here aren't that large. So I'm never going to get a dividend in Target that's going to be enough to buy another share, and Robinhood does not have a DRIP program. But I do plan on keeping my dividends in this Robinhood account. All in all, I think I'm set to get like maybe $25 to $30 in dividends every single month on this Robinhood account. And a big part of that is due to my other holdings, like APLE. So APLE is a high dividend stock, which I have about 1.5K in. Every single month, I'm going to get a really nice amount of dividends here. So I plan on keeping my dividends within the account, but they won't necessarily be reinvested in the traditional sense. And that's something I'm totally fine with, because some of these stocks, the majority are going to be very aggressive stocks, but it's nice to get a little bit of that guaranteed income. So that's kind of my strategy on this Robinhood account. Obviously I'm a swing trader, but I'll dabble in both if it's a good buying opportunity. Okay, so that's going to be it for this video. Definitely let me know if you guys managed to get into some really good positions over this past correction. There were so many good buying opportunities. So let me know if you guys are excited about any of your particular average costs and things like that. So that's going to be it for this one. Hope you guys have a great day and good luck trading.